Hey guys, welcome to lesson 1, and today we're just going to go over the institutional candle, right? So as you all know, and if you're on my calls, a lot of the time you hear me talking about an institutional candle in this smart money trading that we do, right? So I just want to explain a brief explanation of what an institutional candle is and how it comes into play and how we use it in our advantage to take entries, very accurate entries, as you can see in this example right here. So if we go off to the side, guys, I'm going to draw a really quick diagram here. Delete this. Right. So I'm going to draw a horizontal line up and down and just draw zigzags up and down. Now, as most of y'all can recognize right here, this is support and resistance, right? This would be considered support. This would be considered resistance. So basically what price is doing here is it's bouncing off the top, then going down, then bouncing up and down, up and down. So a nice example of support and resistance is if you take a bouncy ball and you hop it off the floor and there's a roof above it, it just keeps jumping up and down, right? And it keeps hitting off the roof and the floor. That's exactly what support and resistance is. And this is one of the first things you're taught as a retail trader. One of the first things, right? So what do they teach you to do? They teach you to sell when price comes up to the resistance level and then to buy when price comes down to the support level, right? So what are you doing here? You're selling right up here, right? Sell and then sell again. Now, what do they teach you as well? The more times it hits, the stronger the level gets. And the more times it keeps hitting that level, the more people can see that, right? So once it hits once, it's still not considered support. Hits twice, boom, starts getting created. The third time, more people can see it. Then once it reaches the fourth time, at this point, everyone can see it. It becomes very clear and significant to all the masses, to all the noobs out there. Remember, that's what you're taught. The first thing, I still haven't come across a trader who doesn't know what support and resistance is yet, right? And then what are you taught here at the bottom? You're taught to buy at support, right? Boom, you're buying up here and you're selling up here, right? So once you're doing the buying and the selling, what are you doing exactly? You're placing your stop losses, right? So when you're buying here, where are you placing your stop loss? You're either taught to look left and place it below the low, wherever it is, so your stop loss would be placed here. Or maybe you're taught to place it 10-20 pips down price, whatever it is, right? So maybe you're taught to place it 20 pips below price. And you're just doing that. People are just placing their stop losses. So much stop losses are being built up. What does that mean to us? That means that a lot of liquidity has been built up under these areas, right? Under these lows, under the support. Lots and lots of liquidity has been built up. Money. So much money being built up under here. And the same thing up there. Stop losses means there's so much money being left up there, right? Why? Because once your stop loss gets hit, then you're either selling or buying back your position into the market, depending on if you're in a short or long, right? So that's what's happening. So why is this significant to people like me, the smart money traders? Because we know that the banks and price is attracted to areas of liquidity. So an area of liquidity is where there's so much money sitting, right? So that could be double top, double bottom, equal highs, equal lows, support and resistance, trend lines, because some people, they buy at a trend, right? So you might see, quick example, let's just say that there's a trend line here, price keeps going up, and it hits that trend line, comes down, respects it, hits that trend line, and what are people doing? Whenever price comes back down and hits the trend line, they're buying, so they're placing buy positions. So what's happening here? Everyone can see this trend line. This trend line becomes very obvious to the masses, right? And boom, they're placing buy positions. And it becomes very obvious. And the more times it hits, more liquidity has been built up, right? More people are getting into the market. Remember, the more clear the support and resistance is, the more likely you're going to get clapped. Because so much money has been built up there, right? So, as I said, why is this important to us? if you take a look, usually what happens around areas of support and resistance, equal highs, equal lows, you usually find a very, very strong candle that gets created. Let's pick the purple color right here. Goes down, clears liquidity, boom. So you usually get this huge candle that clears liquidity, clears all the stops because people were buying here. And then straight away after that candle, you get another candle. Boom. That usually engulfs it. Just like that. So you get the candle, takes out liquidity, and then straight away you get a big bullish candle after that. And then you just get another continuation. Sometimes it continues up. It just keeps going. And the candles keep going. Now I apologize for my bad drawing, right? So what happens here? We have this last bearish candle left. What's this candle called? This is called our institutional candle. Now this is the candle where basically you have to do most of your training to spot. You have to train your eyes to spot this institutional candle all the time. Why? Because this is the last time the banks sold down to buy up, right? They sold down to buy up. And what are the banks doing here, or the big institutions, whatever you like to call them? They are using their own money to send price the opposite direction of where they want to go, right? So they're using their own money to place huge, massive orders, right? Buy orders, boom. Just place massive, massive lots. Now remember, guys, you always have to think of it this way. Who has the most money in this industry? It's always going to be the banks, the big institutions, whatever. If you look who controls the markets, it's all the big banks like HSBC, JP Morgan, whatever it is, right? It's not the retail trader. It's not your standard lot, 10 lots, 100 lots. It's much, much bigger than that. And if you ever seen an order book of the institutions, it's absolutely massive, right? That's what's happening. So what are they doing? They're using their own money to push price up. Now, in this instance, they're obviously going to be in drawdown because they're using their own money. So they're in drawdown right now. They're in loss. So what do they have to do? They have to come back down and close out their positions, right? So they have to come back down, price comes back down, and they have to close out their positions at break even where they first started buying, or at a little bit of profit. That's exactly what they do right here. So price comes down, boom, hits that institutional candle, and that's where we determine our entries because the most volume's there. So this would be our entry, the open of the candle or 50% of the candle. Now I'm going to take you guys to the graph, to the chart in a second, right? Or 50% of the candle. These would be our entries. And then boom, price takes off. So we have to train our eyes to spot the institutional candle. Now I'm going to take you guys to a trade that we just took earlier on and we sent out to the team. This is GBP USD, right? So we're going to take a look at this on the 30-minute time frame. Now this concept works on any time frame. It does not matter what the time frame is, the daily, the 4 hour, the 2 hour. But one rule that I go by is the higher the time frame, the more high probable it is. So usually what I like to do is look at the higher time frames for my directional bias and then go down to the 4 hour or the 1 hour time frames to pick out my entries. And then for re-entries on the smaller time frames, which I'll teach you guys as the time goes on, we take our re-entries, right? So in this instance, we use a 30-minute for our entry because, as you can see, the institution candle was the clearest here. So what did we have? Price was playing around what you could call resistance right here for retailers, right? Just draw a line. So price kept coming down, touching off that line, and away it goes. It buys up, comes down, touches off that line, and it buys up. Touches off that line, and it buys up. What's happening here? This could be considered the fourth touch of the support. And as you can see, straight away, lots of bullish candles have been created, right? So this is inducing so much buyers into the market. So a lot of people are buying. Then what you have, straight away, you have three huge, massive bearish candles, right? That come in, and people that have all their buys here, where their stop loss is at, all beneath here. So liquidity, money has been built up here, right? What happens? It takes out all liquidity, all stops are hit, no matter where your stop is at. This went 40 pips under your stop, right? So most people would have gotten stopped out anyways. Then price boom, pushes up straight away very, very strongly. So it takes you out and then it goes in your direction. So what do we see here? This is the example of our institutional candle because it was the last bearish candle after the big up move. Now, when your institutional candle is engulfed, it makes the trade more high probable. Now, bear in mind, it does not make the trade invalidated. It just makes it more high probable. So that's what we have in this instance. So, as I said, price has to come down, plays up, it goes up, 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 up. They're still in drawdown throughout this whole period. They're in drawdown. Then boom, straight away, price comes back down. So they mitigate their orders out. And where do our entries? Where do we take our entries from? The open of the candle and 50% of the candle. So what do we use? We use our Fibonacci tool right here. And boom, 50% of the candle. Place it on the 50%. Comes down to the 50% beautifully. Triggers in. And away it goes right now. We are in nearly, it went for up nearly 50 pip profit, right? At the moment, it's like 40 pips profit, right? So that's an institutional candle. Let's get another example of an institutional candle. Let's see. Right, so if we take a look at a GBPCHF in this instance. Right, so as you can see, we have GBPCHF. Now, there's so much other things to consider when you're trading, but we're just taking a look at the institutional candle. By this course, by the end of this course, guys, you should be able to completely trade on your own, and this is what this course is about, making everything so simple for you, right? So as you can see on a 1 hour time frame, we have that last push down that takes out the liquidity, this double bottom right here that you can see. So liquidity was sitting around here. We had consolidation, that push down, that was the last bearish candle before the up move. Straight after that bearish candle, you can see a huge push up. You know by this that the markets were in play right here, right? That the banks were in play. So what do? We take our entry off the open of the candle, 50% of the candle, so somewhere around here, right? Where would our stop loss go? Below the candle. And boom, target the equal highs. Now I'll tell you guys why we target the equal highs in the next lesson, right? So where does the stop loss usually go? I usually like to place my stop loss just under the institutional candle, or maybe the wick here or the wick here. This is the beauty of this, because our stop loss is still so much smaller, and this still allows us for a 4-to-1 ratio, 7, 9-to-1, 8-to-1, wherever it is, right? So small, but these trades are so accurate that, as you can see, it hit to the pip. No drawdown on GBPCHF and GU. No drawdown right here. Touches off that, and away it goes. If you want to take a re-entry, then you go down to the smaller time frames and you look for the exact same thing, right? The exact same thing on a smaller time frame. The last push down before the up move. And it's the exact same thing over and over again, right? So that basically explains the institutional candle and the basic principles of the institutional candle. One more thing that I'd like to add on here in GU. A big thing that you should look out for is this 3 consecutive pattern right here. These last 3 candles that make up an institutional candle. So if you go onto the 4 hour and your institutional candle is on the 4 hour, go ahead, check on a 1 hour time frame or the 30-minute time frame and see if your institutional candle is made up of these 3 consecutive candles, because usually this is a very high telltale sign that the banks were in play at that point, right? So that's really it, guys, for this lesson. I hope you guys gained some value, and I'll catch you all on the next one. Thank you very much for listening.